So this is the Electrum Breakout Room. We're very proud to be one of the sponsors for the PIPC conference this year. In this room, we'll have a number of really interesting sessions that we'll present. My name is Rinske. I'm Rinske van der Bijl. I work at Electrum, and it's my honor and privilege to be introducing some of our very, very nice speakers that we're going to have today. So first, we're going to have Pierre Coetzee. He's going to lead the session, and he's also going to introduce Andy White. He can do it much better than I can. And this session is all about the regulatory landscape and that the changes that are going into place in this landscape and the impact that those changes have on the payments processing, the payments landscape. So let's put our hands together and welcome Pierre Coetzee and Andy White, please.
Thank you, colleagues. Yeah, you can hear me. Rinske, Andy is the presenter, the nice presenters. I'm going to facilitate. So, colleagues, thanks for joining the session. It is a discussion between Andy and I. It's about the changing landscape and the impact thereof. Andy is the CEO of the Australian Payments Association, AusPayNet. Andy also holds various advisory positions on the PCI Council, INVICO, Emerging Payments Association Asia, and the editorial board of the Journal of Payment Strategy and Systems. Now, some of you, in fact, I think most of you, will remember Andy was involved last year when we developed the design principles for the PIB. Andy advised from his perspective, and many of those principles and suggestions were incorporated in the design principles. So let's put our hands together. I hand over to Andy. Andy is going to take us through his presentation. Thereafter, we will go into conversation and we will give opportunity to ask questions as well. Andy, welcome again.
Thanks so much, Pierre, and thanks to PASA and also to Electrum for having me. When thinking about this topic, and I was thinking about the themes for day one of PIPC, and we're talking about big bets and inflection points. I mean, my argument would be that regulatory settings are a big bet. As I'll talk about in a second, you don't change your regulatory settings for payments or financial services that often. So it's a pretty big bet because you're betting on whether those regulatory settings will stand the test of time and serve you well for the next couple of decades before you then review them again. So it's very much a big bet and a potential inflection point for whether payments work or don't work in terms of issues like consumer protection, facilitating innovation and driving the digital economy. So first is quickly who are AusPayNet or Australian Payments Network. It's interesting, in the back of my head I can hear Chris Hamilton talking, who many of you would know, and he used to be the CEO of Australian Payments Network. So there we go. We've got two CEOs of Australian Payments Networks talking at the same time. Our mission is confidence in payments. We're the industry body and self-regulatory body for payments in Australia. We have over 156 members now, pretty diverse across financial institutions, merchants, payment operators, big tech companies, so Google, PayPal, within the payment operator space, all of the card schemes, for example, and as well as emerging pay tech companies as well. Pretty diverse. Within that industry association and self-regulatory role, we really do three things. The first one is to set standards for the way that payments operate and indeed things like the way that we mitigate economic crime. The second one is to lead large-scale transformation programs. So things like the ISO 2082 migration, for example, we led by a lot of central banks in most countries, but led by us in Australia. And then the third one is what we term insights, which is really advice, particularly to government and to regulators around payments. We're not an advocacy body. With 156 members, we can't advocate for that broad range of members, but we do provide significant advice, and some of that advice is relevant to this topic around regulation. And I should say, by the way, at the outset, I'll talk for hopefully around about 10 minutes, then Pierre and I will have a bit of a conversation, and please do throw some questions in on Slido to facilitate that conversation as well. So talking about big bets, the last time a big bet was placed on regulation in Australia was back in the late 90s with something called the Wallace Report that looked into the Australian financial system. It led to the Payment Systems Regulation Act in 1998, and of course there's a beautiful symmetry with South Africa because your National Payment System Act was also in 1998. So we're talking about the same sort of time, 25 years ago. In some ways, that review into payment regulation had a lot of foresight. So it talked about the need for a separate payment system board under the RBA, really tasked with thinking about payments policy from an economy perspective. It talked about AusPayNet, then called APCA, continuing its role, but with a broader membership. And as I've just described, we now have that broader membership. If you go back to when we were founded 5 years before the Wallace Report in 1992, we had 9 members. So we've grown quite significantly since then and diversified. They were all banks. And I'll talk about the flaws within the Wallace Report around banking in a second. Also talked about stores of value. So really anticipating things like PayPal, digital wallets, etc. And then it also talked about an issue that is pretty current in a lot of economies at the moment around regulation, which is direct access to the central bank for non-banks. So what I term there on the slide at ESAs, that's our exchange settlement accounts in Australia. That's an account with the Reserve Bank, the central bank, and really was suggesting back in 97 that should be liberalised so that other non-banks could have those kind of accounts. Step forward 25 years and we have that. So companies like Wise have direct accounts with our central bank as they do with other central banks elsewhere. However, the Wallace Report had some flaws in it, and some understandable flaws. In 97, you could probably make some simplifying assumptions around the way payments worked that made sense then but don't make sense now. There were 2 big ones. Those simplifying assumptions were that really if you regulated what I would call money at rest, so deposits, you regulated money in movement payments. And that worked because only banks were processing payments at that stage. It doesn't work now because you have lots of entities who process payments who don't take deposits. The other one was that if you regulated payment systems, you regulated the whole of the payments industry. That again doesn't work when we've stepped forward to a world where there are payment services that use those payment rails or payment systems but aren't themselves systems. So think about things like buy now, pay later, for example. It's a service on an existing system, the card rail or the account-to-account rail. So as we step forward 25 years, there was a need for a review, similar really to the review that you've had here, looking at both the role of PASA and the role of the Payment System Act. So that review took place in 2021, and it really focused on 4 principles that I'll quickly run through around 4 S's: service, strategy, simplicity, and safety. Service, really, the message there was that the focus should be on the end user. At one level, that's pretty obvious, but it's really changing that mindset around what are we regulating here? Is it the payment system? Is it its payment system participants? Or are we trying to regulate to try and get outcomes, policy objectives for the end users of those payment systems? So it's really putting the end user at the heart. And there's a lot of similarities here with reviews that were done into open banking in Australia, what we call the consumer data right. Funnily enough, written by the same reviewer. So again, in the data context, that was about putting the consumer at the centre. Here it's about putting the end user, so consumer and businesses at the centre. If we move on to strategy, the main recommendation there was that the government should create a strategic plan for payments. The rationale there is that prior to that strategic plan being created, a lot of regulatory measures and steps had already been taken piecemeal, and they've been taken piecemeal without those policy objectives that I just described being front of mind. So, where's the end user? What are we trying to drive here? And the idea with the strategic plan is that it would be really clear on those policy objectives and drive those kind of outcomes for end users, and would be reviewed every 18 months. So it's not just a stake in the ground, it continually is reviewed to improve over time. The good news on that one is that we've had the first publication of the strategic plan from the government. Very clear idea, building a modern and resilient payment system. It's very, very clear on those policy objectives for end users, and it's really clear in terms of what that means for the priorities around initiatives for the payments industry. A lot of which we're involved in as the industry body. So on the bottom half of that slide, you can see initiatives around financial crime, so particularly scams, cybersecurity, dealing with legacy systems, so that's both checks and our direct entry system, or ACH, and really sort of pushing the move to real-time payments. It's also got a cash component in there around how do we maintain access to cash, and it's got some pieces around cross-border and central bank digital currency. I'm not going to major on those today. If you do want to discuss those, please grab me at any time in the next couple of days or throw a question in on Slido, because our focus today is on regulation, really on the top of the slide. The main pieces there were looking at that Payment System Regulation Act that dated back to 1998. How is that modernised to make it future-proof? And then also establishing a new licensing framework, and I'll go into both of those in a second. So on which, in terms of simplicity, the key recommendation was there to expand the definition of payment system within the Payment System Regulation Act, and that's really to deal with those services that aren't really a payment system, but are clearly prevalent across the payments ecosystem. It's also to help the RBA regulate a broader set of participants than it would have been able to do previously. So to use an obvious example, something like Apple Pay wasn't captured by the old Payment System Regulation Act. It will be captured by the new Payment System Regulation Act. And again, the good news there is that we've already had a consultation on what that act might look like going forward, and it really will address those points around services and participants. Then on safety, this is really all around licensing. And although it's under the safety banner within the review, I'd actually point out that this licensing is about a few different things. So it is about consumer protection. You know, effectively, consumers were increasingly processing payments through entities that weren't licensed. But it's also about innovation. What we analysed, and our advice to government on this, which was reflected in the report, was that when you look at other jurisdictions where they have, for example, an e-money licence, so somewhere like the UK, Europe or Singapore, actually those licensees are supported by the wider payments ecosystem in a way that they wouldn't be if they weren't licensed. So if I'm a pay tech company, I want to focus in on my customers. I actually don't want direct settlement at the central bank. Someone will provide that settlement at the central bank for me if I'm licensed. They won't if I'm not. So it is about enabling innovation as well as protecting consumers. And crucially, the recommendation was around a tiered payments license. So similar to the discussion that was happened earlier on today, you know, we're not going to regulate everybody as if they're a bank just because they're processing payments. We'll regulate them based on the function that they perform within the payment system. So again, we've seen the first consultation on that. It's the first of two. The next one will be later this year, around what that licensing regime might look like. It is very much that sort of function-based regime. Again, you know, there are really good parallels, I think, with some of the work that's been done in South Africa as well, and particularly in terms of the Conduct of Financial Institutions Bill that talks about activity-based regulation. Very similar idea here. You'll be regulated on the function or functions that you perform, and then the license that you have will tier depending, and your obligations under that license will tier depending on those functions that you perform. So the idea here is to make it an efficient regulatory licensing regime, but one that does protect consumers. So as a consumer, I know I'm dealing with someone who's licensed when I'm processing a payment, but also enable innovation. And as part of that licensing regime, again under safety, there's a recommendation that is very pertinent to us as the self-regulatory body, which talks to the fact that one of the obligations that licensees will have is to meet industry standards that are set by authorised standard-setting bodies. Now, that concept of an authorised standard-setting body doesn't currently exist in Australia. It will do once the licensing regime is in place, and we've started work to become an authorised standard-setting body. The key bit of that is that those standards will apply to anybody who is providing a function within the payments ecosystem. So they don't have to be an AusPayNet member. They just have to have a license. And if they have a license, then they will be subject to those standards. And that's obviously pretty critical, both from that consumer protection lens and that enabling innovation. It becomes really clear if I'm an innovator, what are the requirements that I need to meet? What standards do I need to meet? And again, the consumer can have confidence in the payment because they know those standards are being met, and it creates a level playing field between all the different participants in the ecosystem. So what do we think the impact of all of that regulatory change is? Well, as I say, it is a big bet. It is an inflection point. It is a whole range of participants who aren't currently regulated being regulated. Our view is that that does create that level playing field, what we call same risk, same rules. If I'm providing the same function, I'm going to be regulated in the same way as someone else providing that function in the payments ecosystem. We think that will enable innovation. More than that, actually, we think it creates a holy trinity of positive outcomes. So enabling innovation, protecting consumers, and driving economic growth through that. So we think it's really good in terms of the outcomes that it can bring. And as part of that, of course, you get competition and choice between different providers, but on that level playing field basis. So that's really a summary of where we think those regulatory changes can, or what outcomes those regulatory changes can drive. I might stop there and have a chat with Pierre. Thank you.
Thank you, Andy. Most insightful, must say. If I look at the similarities, it's mind-boggling, but we'll chat about it. Colleagues, we will open for Slido questions. You can post your questions in the meantime. So, Andy, looking at the overarching strategy, what will a modern and a resilient payment system look like in Australia?
So I think it'll look different in a few ways. So I think it'll be simpler than the one that we currently have. My sort of throwaway comment is that most economies are really good at setting up new payment systems and terrible at closing down old ones. And so the point I made about legacy systems, I think, is really important in that it's a potentially confusing payment system in the whole at the moment because there are too many rails in it. Yeah. So we need to deal with checks. You've already done that in South Africa, and we point to that example. New Zealand has done that as well. The government's plan actually includes end dates for government's own use of checks of 2028 and the closure of the check system in 2030. We think that's pretty long. South Africa and New Zealand both closed their check system within a year, and check volumes are incredibly low in Australia. So about 0.1% of payments are made by check now. But interestingly, that's still around about $1 billion a day, which is a lag on the economy. So I think dealing with that, dealing over time with our ACH system, where logically the use cases that it solves for could be solved for by more modern payment systems, such as our real-time payment gateway, such as cards. I think that will provide a much simpler payment system. I think it'll be modern in other senses, in the sense that the flow of data, there was a bit of discussion on that earlier today as well. The flow of data will be better enabled, so things like ISO 20022, which we see helping straight-through processing, helping choice, so that choice can be made by users of the system based on what facets do they want out of their payment. Does it need to be sanction screened? Does it need to go through AML, KYC? Is immediacy important? Is liquidity important? In which case it can go to real time, or it can go to high value, or whatever it might be. So it'll enable that choice. So we think it'll be more data rich than it currently is. And then I think the focus on resilience. Pieces of work that we're doing there are around changing some of the networks that support payment systems so that they have inbuilt resiliency. Also moving the security standard for cards so that it's less subject to cyber attacks, those sorts of things. So I think simpler, data rich, and more resilient.
Thank you. Yeah, again, I think we can keep ourselves busy for the rest of the day. Just a few trigger points such as FATF, we know, and you're talking about data rich. But let me not waste time on that one. Switching to licensing. Interestingly, how you deal with licensing and just for take it closer to home, colleagues. We know National Treasury issued the draft bill on the conduct of financial institutions, which also introduces consequential changes to the National Payment System Act. In terms of that, and I see you refer to the term function, we call it activity-based regulation, again, a similarity. And as well as the responsibility of the SARB, the Reserve Bank, to license entities. Now, we believe there might be more than 300 entities that will be licensed over time by the Reserve Bank. If we look at that, is there alignment among the participants, these 150, and you mentioned, with regards to the licensing regime and dissent for that matter?
Yeah, so broadly the answer is yes, there's alignment. I'll come on to dissent in a second. So broadly there's alignment because I think, like us, most of our participants see the benefit in that level playing field. So even those that aren't regulated currently would see benefit in being regulated because of the positioning that it gives them in terms of the protection of consumers and also the opportunity to partner and collaborate with other members of the payments ecosystem because they're licensed in a way that they wouldn't be able to if they weren't. So, simplistically put, our bank members would be supportive because they'd say, well, at the moment I'm the one that's regulated to a certain standard and others aren't. But interestingly, the other side of the fence, the non-regulated, see the benefit in being regulated. The only dissent that we've seen, and one of these is a member of ours and one isn't. So Google is a member of ours, Apple isn't currently. They have both argued quite strongly that they aren't payment participants. And literally, so the sort of classic argument that they gave was before the Senate Economic Committee, the representative from Apple had a leather wallet in one hand and a phone in the other, and said, "Well, you wouldn't regulate, the provider of a leather wallet. Why are you regulating the provider of a digital wallet?" I mean, our view is they quite clearly are payment system participants, and more than that, they're significant. They're systemically important payment system participants. I mean, if Apple Wallet was down, there would be a major problem. That's really been the only dissent, and I think the right way to look at that is to say to Apple as an example, well, you're not going to be regulated in the same way that one of our banks is. You're going to be regulated based on the function or activity that you provide. And I mean, I think it's interesting, Pierre, just on that. That does seem to be, I think I had it on one of the slides, that does seem to be the way that international best practices evolved. Okay. I mean, the Swiss are the poster children for this in terms of they've been doing activity-based regulation for a while now. And so I don't think it's surprising that both Australia and South Africa are moving in that direction as well.
Yeah. And it just, by the way, I see you put it under the heading of safety, and consumer protection comes to mind. Well, we can think of a lot of things. It gives certainty to the payment institution or the licensee in that sense. I am licensed, so I can participate. There's rigor, there is oversight, supervision over those entities. So from multiple perspectives, we see policy objectives playing out also in your jurisdiction?
Yeah, absolutely. So I think it is safety all round. There is a consumer protection element to it, but it is also, the payments ecosystem is exactly that. There are dependencies between different providers at different points in the life cycle, and therefore it provides that safety and certainty for other participants, which I think is important to bear in mind as well.
Yeah. Andy, I want to move to the regulator. It's always key that you have a regulator that's informed, that's enabled, empowered in terms of legislation that gives the framework. Now, if we look at the RBA's, Reserve Bank of Australia, their role in this, how is it likely to work in practice? Licensing, getting involved more and more into these activities.
Yeah, it's a really good question, and it's not one that we have an answer to yet. The second consultation that we see coming out later this year on licensing will talk to the obligations of licensees, but we'll also talk to some of the structure around this. It's not an easy answer in the Australian context because the conduct regulator that we have, ASIC, doesn't really have any experience in the payment space and tends also to be a bit black and white. You either have a license or you don't. And so, non-compliance leads to revocation of the license, not any other sort of penalty. And it's pretty clear that the prudential regulator that we have, APRA, is largely just going to stick to banks. I say largely because it has a role in stored value, but when you're just talking about payment service providers, it logically doesn't have a role. So there's a bit of a question as to, is it an extension of ASIC's powers as a conduct regulator, or is it something that falls to the RBA? And the RBA, the Reserve Bank, have a range of powers that will be broadened by that review of the Payment System Regulation Act, which is positive, but they don't license anybody currently. They tend to only set standards where effectively it's a commercial matter that industry can't solve for, so we can't solve for as the self-regulatory body. So it would be interesting to see whether they want to step into this space in more of a way than they currently do. The only point that they definitely will step in on is so that authorisation of standard setting bodies, and we aspire rightly to become probably the standard setting body, but maybe one of the standard setting bodies. Those standard setting bodies will be authorised by the Reserve Bank, so they'll have that additional role.
So what you're saying is the RBA will license or authorise you to issue standards.
Correct. And so that's quite a significant change to the model that we have currently. I mean, I think self-regulation, in some economies has a bit of a bad name because it's seen as, simplistically the banks setting the rules for the banks. We feel it works. The review that's been done into Australian payments regulation recognises that it works because actually our broader community, it's not the banks setting the rules for the banks, it's payment service providers in the broad setting those rules for all of the ecosystem. But I think the step beyond to say, if you're licensed, you will need to meet those standards is important. I mean, selfishly for us, it gives us a regulatory standing that we otherwise don't have. But actually, more importantly, at a higher level, it makes sure that those licensees are all meeting the same standards, irrespective of whether they become members of ours. Now, obviously, if they become members of ours, they have an opportunity to input to the development of the standard. But if they don't, they're still bound by the standard, and that's pretty important.
Okay. Yeah, interesting to see how this will play out in Australia, similar to South Africa, where we talk about the PIB, Payment Industry Body. And as we read it in the COFI bill, what we take from there is that body might be licensed by the SARB as well as a scheme, and they will be authority to issue rules. So would it again, and colleagues, I want to take it closer to home every time because I see there's a lot of parallels or similarities. And it will be interesting to see how it plays out, and if a year from now when we sit here and talk again, did it work, did it not work? Was there a conflict of interest or not? And these are the questions that's just playing around in myself and some of the audience maybe.
Yeah, and I think just as a sort of reflection on that, when I talked earlier about regulatory settings being a big bet because you don't review them terribly often. I mean, we're sort of 25 years worth of review. I think you were slightly ahead of us. You might have been 18 or something when the review started in 2016. But it's going to be every couple of decades. So you want to try and make them future proof. I think the way that the government has thought about licensing in general, it should future proof it. So it's gone beyond that sort of 1997 view of the world that it's just banks that we need to care about. It's very much payment system participants, it's systems, it's services. It's difficult to imagine something in the payments system ecosystem that doesn't fit those categories. So I think it's future-proof from that angle. I think also the fact that you don't review these settings very often is a reason why some kind of self-regulation or standard setting is important, because sure, you can argue that there may be conflicts of interest there. It's our job, we feel, to manage any of those conflicts of interest, and also to make sure that the end user voice is genuinely heard when we're setting standards, and that's critical. But if you run the counterfactual and say, well, actually, there shouldn't be an industry body setting standards, then you're only left with two options, really. One is regulation and one is legislation. And both of those tend to be very slow. Really, if you want to be agile, which I think is a necessary condition of being future-proofed, if you want to be agile, then you have to have some kind of industry body setting standards.
So, Andy, that seems to be one of the benefits of new changes. If we look at the benefits, are there any other benefits with regards to consumer protection, innovation, and the economy itself?
Yeah, so I think so, because, I mean, so if I use some practical examples of standards that we set now, we did some work recently on QR codes. We had a range of inputs to those QR code standards. So that included individual merchants, it included merchant groups, it included consumer advocates, and a whole range of innovators who were thinking about QR codes in very different ways in Australia. And by the way, QR codes are only probably ever going to be edge cases in Australia, but they could become quite important edge cases. There's one of our major merchants who is using QR codes now as one option for a consumer at checkout, and they're doing that because they want to process loyalty or rewards as well as the payment, and so get away from having to tap two cards to just using the QR code that processes both. Now that's important because that touches on your question of, by involving consumers and merchants, we were very clear on how we could protect end users in a QR code enabled world, and we were very cognizant of some of the QR code scams that you'd seen in other jurisdictions like China. But then also we needed to support that innovation, and so we did that in a way by looking at international standards on QR codes, so EMV code's the obvious one, that doesn't process loyalty and rewards. So we had to effectively end up with what we call a short form QR code standard, which is EMV code. If you're only processing the payment, you use that. But if you want to process loyalty and rewards, then you use our longer form QR code standard. And so I think, definitely benefits in terms of supporting innovation and protecting consumers.
Andy, I'm getting to the last question. Now, I know it's so generic, but it needs to be asked. And is there a one-size-fits-all? And talking about the strategy and a model and even a regulatory model that could be adopted internationally. And I want to ask this question more specifically with regards to all the similarities. And we've seen 98, the Payments Act, 98, our National Payment System Act, and a few of these things playing out continually. So is there a one-size-fits-all?
So I think my short answer is no. But my longer, more nuanced answer is I think you can always learn from other jurisdictions. We hopefully try and do this all the time. And you mentioned the input I had on the PIB work, which I was really grateful for because I felt like I learned a lot, as well as providing input. I think there are elements that And I think the Australian review certainly learnt from other jurisdictions in forming these elements. There are elements that you could usefully apply irrespective of jurisdiction. So particularly this idea of having a strategy written by government. And that was a real change, by the way, in Australia, because previously Treasury, our government agency, had kind of sent the Reserve Bank a set of expectations that it reviewed every couple of years and were very, very high level. Basically, look after payments policy for us, please. That sort of expectation. So to actually put government in the chair to say, right, you need to set the policy objectives for payments moving forward. I think that's the right thing to do, because otherwise you get very knee-jerk regulatory responses. So just as an example there, within Australia, we've had a push over the last few years for what's called least cost routing, or I would say merchant choice routing, where they can choose the network over which they process a card transaction. And that really came from government. But it was a really poor policy objective, because the policy objective actually should have been lower merchant cost. And how it's implemented, whether it's by routing or it's by another mechanism, is really up to the market to decide. So I think you can definitely apply that kind of logic in any jurisdiction. Start with a high level view of the policy objectives that you're looking to get to. And I think the other positive aspect of that is the commitment by the government to review that every 18 months, because it just keeps it current. And I think it also, as well as getting around some of those knee-jerk regulatory responses, it also helps industry in terms of investment decisions. What are the actual priorities that we want to face into in a world that's increasingly complex, where we've got a lot of choice? What do we actually need to prioritise and do on behalf of those end users? So I think that would probably be the main takeaway.
Yeah, that's helpful. Thanks, Andy. Just want to add this. I think listening to Richard saw this feedback this morning on financial inclusion, where our financial inclusion model is vastly different than maybe the rest of the developed countries, if you look at that. So in South Africa, there's a huge focus on financial inclusion. So will it, and that's a question to all of us, will it change how we deal with regulation and application thereof in South Africa? Now, thank you for all your questions. We've received many, and I would not be able to judge on the merit. I'm going to ask this question and work my way through this, Andy. So it says, in terms of licensing of new entities into the payments landscape, in your view, do you have any ideas how the landscape should be opened up to non-banks? And I think there are many non-banks. It's critical that we accommodate, even by way of regulation.
Yeah, I do. I just want to make one comment on financial inclusion, by the way, because you mentioned it, Pierre, before I answer that. So having been in India a month ago, my reflection on the earlier conversation is India achieved its financial inclusion goal 4 decades before it was due to, which is incredible. And UPI is part of that. But it could only do that because the regulation on UPI was lower than the regulation would have been on other payment systems. And so, if you're serious about financial inclusion, that's a way to do it. You have to have tiered regulation. You have to acknowledge the fact that there may be risks associated with that. So in terms of opening up to non-banks, we've lived that journey. We've lived that from a membership perspective. We have a significant number of non-banks as members now. As I said earlier, non-banks now have access to exchange settlement accounts, so direct settlement at the central bank. I think it is all based on that function-based regulation. So it's pretty clear if I'm a payment service provider, I'm relatively small, I just want to provide a payment service, the regulation can be quite a lot lower than if I'm Wise, non-bank, and I want direct settlement at the central bank. If you want the latter, then you have to have pretty clear operational and technical capabilities in order to perform that settlement and not produce systemic risk for the rest of the system. So it is all about that tiering and that function-based regulation, and then you can do it. But it then has to be on a fair and equitable basis between banks and non-banks.
Absolutely, yeah. Thanks again for that, Andy. And you did mention the function-based regulation. In South Africa, we'll have the activity-based licensing. Doesn't matter what type of entity you are, if you are performing this activity, you'll be licensed against that activity. Exactly as Andy indicated. Now, there's one question. I just want to change one of the words there. It says, are we borrowing from Australian payment system? Can I change that and ask, are we leveraging from? But Andy, over to you. It goes on to say, what informed this decision and how compatible is the reforming of the payment system compared to South Africa?
Yeah, look, I think the elements that you took when I was involved in the review, I think the elements that you took were elements that we'd looked at in terms of our own governance of an industry body that I think were probably pretty helpful to PASA. I mean, I think it's similar to your question about, is there a one size fits all? The answer is no, because you have to reflect the South African environment and AusPayNet has to reflect the Australian environment. But can we learn from each other? Absolutely we can, and particularly where one of us has taken the lead on something. We learn all the time from our New Zealand equivalents, our Canadian equivalents, our UK equivalents on different topics, and we need to continue to do that.
Absolutely. And thank you for the use of the word borrowing. So another question I want to pose to you from the audience is anonymous. Self-regulation requires consensus building, which at times take a lot of time. What would be some best practices to speed this up? Are there scenarios or areas where one should just regulate quickly?
Yeah, so the issue is the counterfactual doesn't work because regulating quickly, certainly in Australia, doesn't happen because regulation has to be consultative and it takes longer than self-regulation. So my flippant response is yes, often what we do for a living feels like herding cats and an increasing number of cats who are going in different directions, but hopefully you eventually get them, on the straight and narrow. The more serious answer to that is we work very closely with the Reserve Bank already, and we will do even more under this model where we're an authorised standard setting body. That can be very helpful because the Reserve Bank can set timelines. So they can say, we'll give this to industry and we want a response by X.
Okay.
And if we don't get a response by X, then we'll issue a standard. And that standard is going to be harsher and more penal than self-regulation. We find that incredibly useful. I mean, the other version of that is, sometimes the RBA will set the strategy. So it will say, we want migration to ISO 20022, and we're now handing that over to industry. So it's either which way. If you can kind of turn it into a bit of a broader compliance piece, that can be very, very helpful.
Okay, yeah. Colleagues, we're getting into the last minute. I want to ask this question because it's a quick and easy. How many approved standards bodies do you envisage? Now, if I listened correctly, you mentioned one.
So I think the market efficient answer is one. I'm always really careful what I say on this though, because I don't want to be accused of being a monopolist. But also certainly the way the review thinks about this is that you could have more than one because you may have standards bodies that are more generic, so do things other than payments, who then want to set a payment standard and they would have to be authorised for that payment standard. The obvious example is we have something called the Data Standards Body, which deals with the standards around our consumer data right that I talked to earlier, so our version of open banking. And were they to want to set a standard for payments initiation, that is an open question. But were they to, effectively, they could do it two ways. They could set it themselves, at which point they would need to become an authorised standard setting body. Okay. Or they could kick it to us. Sorry, pass it to us. I'm in South Africa. Pass it to us, and we would do it, and they don't need to become authorised.
Okay, yeah, thanks a lot. So colleagues, many more questions. Unfortunately, we are running out of time. Thank you for your time, and Andy, let's put our hands together to.
Thank you. Thanks so much.
Thanks a lot.